This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au.
To buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.
Well, Matt Williams, thanks so much for coming on Masters of the Market. I really appreciate your time. And I thought before we get into it, I thought it would just be good to introduce Airlie Funds Management and how you guys look to invest.
Yeah, well, thanks, Chris. And it's good to see another bloke who takes a similar haircut view to myself. I think it's a very underrated hairstyle. I think
it's a choice, Matt, isn't it? It's a choice.
It is.
We
of course
choose
it is.
to keep it short.
Yeah. I could have a mullet if I wanted, but choose not to.
That's right.
Thanks, mate. Look, Airlie Funds Management was started by John Sevior. John Sevior and I used to work at Perpetual for over 20 years. And John started Airlie as a boutique funds manager, focused on the institutional market in 2012. Myself and Emma Fisher joined in 2016. We're the co-managers of the Airlie Australian Share Fund, a retail-focused fund. And in 2018, we merged with Magellan Funds Management, the listed ASX company. And we've been with them ever since, which has been a really successful partnership. We've really enjoyed our time with Magellan, who've taken off all those boring things that we used to have to worry about, but very important things: regulatory compliance, finance, legal. And Magellan have world-class operations, and now we can just concentrate on investing.
And you mentioned there your time at Perpetual, which was a huge success story in terms of Australian funds management businesses. Maybe start to paint a picture for the viewer, just how big Perpetual and how quickly it grew during your time there, and then maybe a little bit of colour about what you were like when you entered the building to what your frame of mind was when you left.
Yeah, well, Perpetual, I joined in the early 90s, straight out of university. And look, if I wasn't wearing short pants, literally, I was certainly wearing short pants figuratively. I really didn't know much about anything. And I can contrast that to some of the younger people we hire today, who I find it chalk and cheese. I think I was very, the quality of the younger people today coming through really blows me away. I think they're amazing. And I think back to my time in the early 90s. So the recession was sort of just ending. I was looking for a job out of uni, just took the first job I could get. And I ended up in the Perpetual back office, in settlements, in admin. And I was sitting there one lunchtime, and over this newfangled thing called email system came internal job advertisement for the dealer in the fledgling funds management business, which was upstairs in the building at the time. And I thought, this sounds promising. I'm quite interested in the market. I was interested in business. And so I put my hand up for that job. And very luckily, Peter Morgan and John Murray, who were the bosses of the fledgling funds management business, took me on. And so I started my career as a dealer.
Which is sort of what executing trades effectively.
That's it.
The guys making the decisions.
You're talking to the market. You're talking to the brokers. You're finding out what lines of stock are around. You're then talking that to the portfolio managers and the analysts, and they will give you that. And the portfolio managers will say, Matt, let's buy this CBA that's just been privatised, Commonwealth Bank. We quite like this. It looks too good to be true, in fact. And so we were buying a lot of CommBank in the first instalment.
And what was that? What was CommBank trading for after that got privatised out of the government?
Well, I think they privatised it in a few instalments, if I remember correctly. So the first instalment was only a few dollars.
Amazing.
So, amazing. The great retail investors who hung onto that stock, with the dividends and everything through thick and thin, have done so fantastically well. So that was my job at the time. And then I loved it. I absolutely got obsessed with it. Reading all the books that the fund managers and the other analysts kindly threw at me to read, and then looking at companies. And so it developed from there. I became an analyst. And during this time, Perpetual, which really started off managing internal money, Then we developed this expertise. John Sevior, who I mentioned, who founded Airlie, he had joined not long after me. We developed a great rapport together, and a lot of discussions about stocks. And so from that period, long story short, but Perpetual really got a snowball effect. A lot of external clients, the big super funds were just starting to get going. And it went from, a $1 to $2 billion internally managed fund. So, the Perpetual's history has been private deceased estates, corporate trust, but a lot of the private money was managed internally, and then we turned externally. We went from 2 billion in the early 90s to I think roughly 35 billion at some point. So it was a great journey. We had a lot of fun, but it was just a great time and very lucky. I felt really lucky to join the industry at that point, and it's just been a great experience.
And who were your strongest mentors during those years at Perpetual?
Yeah, I mentioned John Sevior and obviously Pete Morgan, who hired me. But Pete, he ultimately left and formed his own business, a successful funds management firm with Sue Ellen Henry, and so he went off. So John and I really took up the ball and ran with it. And so John's been a real mentor of mine and also a friend. And it's someone you don't work with someone for over 20 years if you don't get on. And we sort of, I think we bounce well off each other. It's been a good relationship where we can have very honest conversations with each other, and it's really very helpful, I think, as a fund manager to keep that. You've got that balance. You've got that check. Someone who's check you and tell you you're absolutely wrong, or vice versa, back you up and make you conviction even stronger. So he's been a great foil. I think we've been great foils for each other.
How do you go about, particularly maybe when you were younger at Perpetual, and you got a lot of really smart fund managers there, how did you manage when you had an idea that you had conviction on and someone who was more experienced and potentially smarter than you said, no, that's stupid? Were you able to stick with it and maintain your conviction, or were you able to get swayed by the more experienced, potentially more intelligent investor?
Oh, yeah, I think you'd listen to all ideas. It's been described to me, investing is like someone gives you a box with 1,000-piece jigsaw puzzle on the front. It says there's 1,000 pieces in this box, but you open the box and there's actually only 200. You've got to make up the investing picture the best way you can, and you find your little pieces wherever you may find them. You'll never get a complete idea, so you've got to listen to all voices. But at the end of the day, you've got to put those pieces together. You're not going to have the 1,000. You're only going to have a couple of hundred, and you've got to make your own decision, and you've got to stick with that. Sometimes you're right. Yeah, someone comes in and says, that piece is wrong. You're reading that the wrong way. It doesn't go here. It doesn't go there. Forget it. So you've got to take all comers, but all opinions. But at the end of the day, you've got to develop your own style, your own conviction, and what we describe as your own anchor. And I think that's an important thing for investors, young investors, to come through, who you've got to develop an anchor. Well, what do you really believe in as an investor?
And what would your anchor be as an investor?
Yeah, I think my anchor sort of has developed around our process. I really bought into the Perpetual process, and really what we've developed at Airlie is just a derivative from what that was in the day. But I think it's changed a little bit. I think my anchor back when I first started was all about, I thought this was a game you could scientifically win. You could do the maths and you would come up with an answer and it'd be the right answer. And then over time, you realize that's not it. Valuation and being a value investor was a lot about maths, crunching the numbers, price to book. What's the values in the private market?
In an era where information wasn't as readily available, and in an era where monetary policy was much more stable, wasn't it?
Exactly. So it was a much more desktop kind of analysis, I think, of breaking down what the information the companies gave out and analysing that. in a very maths valuation based framework. But I think over the years, and also this has been a function of the economies in the companies, is the my anchor has shifted to more quality businesses, because the maths, the valuation, being a value investor, and particularly in the last 5, 6, 7 years, as we all know, as interest rates have been crunched, the prices you can pay for company justifiably are higher because growth is more valuable in a low interest rate environment. And so you can pay higher multiples. So thank goodness, really, over that journey, I've changed, and my anchor is much more around quality and also about how management can affect things. I really didn't understand when I first started out as a young investor what good management looked like. I had no idea. But over the years, you really get that sixth sense of good managers and how they can influence outcomes.
And is it something you admire, that flexibility or evolution, something you admire in other investors? There's so often, even Warren Buffett or Charlie Munger, probably the two of the very best value investors of all time. They've missed so many of the growth opportunities because they haven't been able to evolve, and they have underperformed the market for an extended period of time. It's not taking anything away from their brilliance. But have you seen many people that can be really strong in one style of investing, e.g. value, but when circumstances change, be able to flip that and be really strong in terms of a different style investing? Or do you think most people are more suited to one style over another?
Yeah, look, I can't talk for too many others that I haven't worked with, but I think when I first started as an investor, as I said, I knew nothing really. I was so inexperienced. But you've got to grow. You've got to learn. You've got to grow your thinking. You've got to always challenge your thinking. And going back to that, comment about hiring younger people and bringing them through, that's what's really worked for us, myself and John, is surrounding ourselves with really smarter, younger people who make us think differently, challenge our sort of preconceived notions, and always just keeping your mind open and your mind fresh to new ways of looking at things. And so that's how I think I've developed. And I think John, to the same extent, is much more is the same. Although he's much more wedded back to that valuation. He's got a strong discipline around that valuation, which has worked for him. It's worked nicely for him. But I think compared to me, he's a lot more disciplined on the valuation front. But the other guy I've observed, and look, he pays the bill, so I'm going to give him a plug. But Hamish Douglas, who amazingly turned himself from an investment banker into a great investor, who is who over the years has been very flexible in his thinking and has judged the market superbly and the way he's picked stocks. Has been quite amazing to watch, and has built a fantastic business on the back of that.
And that's something I've asked a lot of people that come on. It's that, do you agree with that idea that there isn't one right or wrong way to invest? There's just a right or wrong way to invest for your skill set and your circumstances?
Yeah, exactly. There's no right or wrong way, but I guess what happens is the risk that where things go wrong is when you deviate from the things that have worked for you, the things that your anchor, if you like. If you start to deviate from your process that's attached to your anchor, then that's where you see people lose ground, and they lose. If you lose conviction in why you own a company or why you don't own a company, you can really, the ground can really fall away from you. And clients are very understanding when you've explained why you're in a stock or why you're not in a stock, because of the reasons that you give and the anchor you have, the process that's around that, and they'll understand that if when things aren't going as well as you'd like. But it's when you change your spots to without explanation, I think that's when you get into a bit of trouble. And
I've heard Emma Fisher talk really eloquently before about founder-led businesses and why you at Airlie like investing in them. Maybe talk us through why you think that's an important thing to invest alongside, and perhaps what some of the data's shown that you've uncovered.
Yeah, look, we've had an inkling for a long time, and there's been studies, in some of the investment journals that show globally that have shown founder-led businesses tend to outperform. And so we just want to test the hypothesis here, and we're going to recrunch the numbers again, but very simply, we did the numbers over the last 12 years. If you'd owned a basket of founder-led businesses that we sort of developed, that we picked out, and there were most of them on the market. We might have missed one or two, but they wouldn't have detracted from the outcome. But basically, if you invested in 2008 in this basket, weighted average basket of market cap weighted average, you would be 5 times your money versus 2 times your money if you just held the market itself. So there's really something to that, and we're always looking for founder-led businesses. In the Airlie Australian Share Fund at the moment, we'd have about 8 names in our 25, 30 stock portfolio would be founder-led businesses. So we're always looking for them. It's not foolproof. It doesn't always work. A good example would be Oriton, which was a long-held family business, went broke only a couple of years ago, went to zero. But generally, it's good, and so we're going to do some more work on that and keep developing that.
And do you think that's because they take a longer term view around how they allocate capital? They're not allocating it for their 3-year contract term. They're thinking, what do I want this business to look like in 5, 10, 15, 20 years' time? Yeah,
you're spot on, Chris. That's exactly why. And they have real money in the game. They have real skin. I mean, this is their...
Skin in the game's a huge one, isn't it?
It's massive. So, and it's like their family depends on it almost, to an extent. Their family and their future generation that they think about depends on this. So my great story is back in the 90s when I started at Perpetual, and I moved off the dealing desk, and they said, here, you can become an analyst, and here's a small little stock we want you to look at. It's called Reese. It's a Victorian-based plumbing. It had quite a few stores around in Victoria, and it was growing. But look, the management don't want to talk to anyone. You can have a look at it. And so, look, I've looked at that company. I started looking at it back then, and we own shares in it. And I remember
what the market cap was back then. It would have been tiny, wouldn't it?
Oh, well, it had 100 million. It always had 100 million shares on issue, I think. And it was less than 200 million at that point.
Yeah.
Anyway, I remember one half year result, and this is mid-late 90s, and the company, the numbers were not. The sales line was good. The gross margin was good. It was strong, but everything below that, the costs were through the roof. Employees, SG&A, very high. And so the profit looked very low, and the shares sort of sold off, and everyone's looking at me going, what the hell? And so I get on the phone, and I managed to call up the CEO at the time, who was basically the modern day founder of Reese, Alan Wilson, and he's now the chairman, and his son Peter's the CEO. But back then he was the CEO. I said, Alan, what's the story? Because up until that point, my whole experience of the market was that companies strived, begged, stole, cheated, if you like. That might be a bit extreme, but begged, stole, cheated their way to delivering profit growth every 6 months to show the market, just really short-term goals.
Hit my bonuses, things like that.
Exactly.
Yeah.
And so I said to Alan, what's the story? And he said, Matt, we've got a real opportunity here. I'm investing for the future. And he laid out, how he could grow that business, grow the network, and become the biggest player in plumbing wholesale in Australia. And it really struck me at that point. It really just laid out to me that I'd been thinking about everything so wrong. Everything was about the short term. And it really then was an eye-opener to me about investing for the long term, culture, building really sustainable businesses. And look, as everyone knows, I think most people know Reese, look at them now. And it's been an amazing business. They absolutely dominate here in Australia. and they've leveraged that, and now they're in the US, and slowly but surely we expect them to be really successful in the US.
Now, I don't know the Reece story nearly as well as you, other than Wilson's a good Carlton people. But at that time in the 90s, when their cost base was growing, was that a time where the bigger competitors were consolidating their centres and just having fewer centres but bigger ones, and Reece were doing the opposite and expanding and creating lots more centres for plumbers to be able to go and pick up their goods from? Is that what was happening at the time?
Yeah, not so much. Really, the big player in the market at the time was Tradelink. And this is a great business study.
Yeah.
So at the time when this situation occurred, when I rang Alan and said what's going on, the Tradelink had double the sales of Reece.
Yeah.
Reece was approximately, I think, 400 million. Tradelink were 850 million in sales at that time. So Tradelink twice the size. Same in profits. Tradelink were making twice the size. Fast forward to today, Tradelink has gone through 2 separate corporate ownership. It's gone through at least 5 or 6 management teams. And its sales today are the same as they were in 1998, 850 million. Their profits have halved. Can you believe it? Over 20 years. Meanwhile, the sales base of Reece in Australia has gone up 7-fold, and profits have gone up 18-fold. So that's the demonstration of, an owner-managed business versus a corporate mindset. Tradelink today it's a small, tiny, because of its profits so low, it's a meaningless rounding error in the conglomerate that is Fletcher Building. And Reece is run by Peter Wilson, as I mentioned, Alan's son, Alan, the executive chairman. So just 2 CEOs in 25 years. 2 CEOs in 50 years. And Tradelink, as I said, management turnover, upheaval. So that's the great attraction of an owner-led, founder-led business.
And so talk about an edge that longer-term thinking can create for founder-led businesses. In terms of funds management or as an investor, what do you look at as being early's edge when you compete on capital markets with other funds across Australia?
Yeah, I think experience, John and myself, experience, and again, that sort of open way of thinking, surrounding ourselves with good people. And you mentioned a lot of people have come out of Perpetual, good investors. And John and I, we don't take credit for much, but we'll take credit for developing good people below us. And, so many people have then gone out to have their own successful careers. The guys running Perpetual at the moment, Charlie Lanchester at BlackRock, John Harbert. So there's been a lot of people have come through, and we like surrounding ourselves with good, talented young people. And then within the guardrails of our investment process, which is quite conservative, focusing on very conservative balance sheets, quality businesses, and management that we've talked about. And then we put the valuation factor last. So, our big mantra is that you don't know what something's worth until you really understand the business. You look at the quality aspects of it, and the financial framework that it has, the balance sheet, etc. So I think our edge is that we've remained disciplined to that over 25 years, surrounded ourselves with new smart thinking, and we try and refresh our the teams that we're with over the years. We don't try and get stale, and so doing that, and then also what we've done is, back in the 90s, we used to have 50, 60 stocks in a portfolio. As an active manager today, you can't do that. You've got to be much more. You've got to have higher market, market share in terms of, your deviation from the benchmark. You've got to really be conviction, and you've got to have concentrated portfolios. So we've really concentrated to our sort of best ideas. We're not trying to cover the whole market. We're just trying to really focus our energies on what we find as really attractive companies, own them, try not to be scared out of the good ones. You could have been scared out of Reece, 100 times in the last 25 years. And there's periods where you own these stocks and they do nothing for 2 to 3 years. And it can be very painful because they're a drag on the portfolio.
And so that must be challenging. So you've got a really high quality business. There must be times in that period where you felt that Reece is now overvalued, or
Yes.
at least certainly not undervalued. But you also must know that if you sell out, it's going to be challenging for you to then buy back in. Is that one of the
Exactly.
challenges that you sometimes face?
Yeah, it's exactly right, Chris. Yeah, so that, and hence why we've hung on to Reece for those 25 years. It's been in every portfolio that I've owned. And Premier Investments, another founder-led business. Solly Lou, Nick Scarley with Anthony Scarley running that. We've owned that for 20 years.
Because it is so rare you get an actual business, particularly in Australia, where we're a relatively small capital market and small population. It is fairly rare you get a business that's truly great that isn't necessarily going to mean revert on the Australian market, don't you think? If you get one, you've got to respect it.
Yeah, you do. And look, they'll go through periods where they will mean revert. I mean, CSL, if you've owned that for 20 years, you've had some pretty uncomfortable periods in that time when the market really misjudged their sort of longer term plan in plasma collection. And we've seen, you've seen times where the stock's down 20%, and things in a lot of these companies. And I guess it goes to, this is where a retail investor can have a big advantage over a professional investor such as ourselves, where we're judged on a much more frequent basis. But having been around long enough, I really do try and take that 3-year view as best as we can. But a retail investor, they can withstand, big periods of sideways, big drops, big drawdowns, and be comfortable that they own quality businesses.
I think the challenge sometimes is when, as an investor or a retail investor gets a nickel Explorer that's 10-bagged in 6 months, and they sort of graph that next to an Amazon and they say, well, we've got the next Amazon here. There's very difference between that and a Reece Plumbing or REA or a car sales or whatever you want to look at. It's just understanding the difference between something that's appreciating rapidly but is probably going to come crashing back down, and something that is one of those longer lasting quality businesses. Yeah,
that's right. Yeah. And you're right about, going back to your mean reversion versus true long-term growth players. And look, and you're right in the sense, most companies in Australia, because as you say, it's a small market, growth is hard to come by, that you do get mean reversion is a big factor in our market.
And the tech businesses, really, the international tech businesses have been the truly great businesses of the last 20 years that don't mean revert by their nature. We've got Afterpay here, which has been a little bit in that ilk, but generally those businesses where their cost base remains fixed, even as their revenues skyrocket, there's just not many of them on our market because it's not what we do here very well.
No, that's true. And but having said that, Amazon, if you've owned Amazon since the late 90s, I think I've forgotten the stat, but it's well sort of documented that you've had to withstand nearly every year that stock will fall 20 to 30% at some point in any given year.
And 90% once, I reckon.
In the 99, yes, that's right. Yeah,
crash. It was a 90% drawdown. So I'm waffling on a bit here, but I'll get back to you talking. Talk me through your investment framework. So you've sort of touched on it. Maybe talk me through how detailed that is. And I guess there must be other times where you don't always have it's not a private business you're buying. You don't always have a month to do all your DD. There must be times, I'm assuming, where you buy now and commit to DD ongoing. Is that how things sometimes work? If there's a capital raise or something, you haven't had weeks and months to get your head around a business, how do you navigate that road?
Yeah, look, going back to our edge, Chris, being around for so long, John, myself, and Terry in our team, he's been in the market for over 12 years. Emma over 10. We've got a lot of corporate history there, and a lot of management history. We know a lot of people, so there's not much. There's not many companies we don't have at least a basic working knowledge on. But before we do buy a company, we've got our 4-step process, and the first one is it's a big gate for us is financial strength. Basically, balance sheet's got to be strong. It's a yes or no kind of answer. And really, where most of my problems in the past, where I've gotten things wrong and really wrong, is when you get that balance sheet wrong. Because once a balance sheet comes into play, the downside in a company can be It can be a lot. So it's really important for us, that financial strength. And this time last year, or in March last year, our fund outperformed the market because of that financial strength. In March, when we had the panic, we outperformed, on that as the market drew down. So the second step then is quality of business. And this is where all the work sort of gets done. This is when you're out kicking the tires, you're understanding the industry structure, and really you're looking for changes, I think, particularly in Australia, where a lot of things are pretty static. You're looking for changes in that industry, how things are being affected. And, we look at businesses such as Wesfarmers and Bunnings, right? We look at conglomerates and think, wow, there's a brilliant business stuck within this conglomerate. And this was 3 or 4 years ago. And we were pushing the management team, saying, look, you should demerge Bunnings. If you want shareholder reward, then demerging Bunnings is a fantastic idea. We didn't get that. We got Coles demerged, but the effect was the same, really. Bunnings became a much bigger part of Wesfarmers. So we're looking at things like that. Is there sensible ways companies can bring out the quality business to the fore that they may have in a conglomerate kind of structure or something?
And is that because it's just harder for investors to get a feel for what that value is? Like when you've got a realestate.com, which is a brilliant business, but it's an easy business to understand because it's one main business unit to get your head around. Is there sometimes hidden value in those conglomerate opportunities because they are by their nature a bit messier?
That's right. And, a running example at the moment would be Tabcorp, lotteries, top 3 business in Australia. But wagering gets all the sort of issues. And, that drove this company, the stock, to $3 recently in the last 12 months. And now there's interest in that wagering. But once that gets liberated, either via someone buying wagering or a demerger, we're going to see some great performance, I think, out of that lotteries business as a standalone company. So
how aggressive do you get with your chats with management? Is it sort of a suggestion and a fireside chat, or does it move into, we'll be voting against remuneration and X, Y, and Z if you don't start to make changes? What's your sort of approach with that line of things?
Yeah, I think we'd like to keep things very rational and professional, and this day and age, most company managements and boards get it. We just like to see a bit more urgency sometimes around their thinking, and it's not just us; it's other shareholders. Everyone can see this because, again, you talk about owner-managed businesses, demergers. You do the studies on demergers. It's obvious demergers work, and so boards. Ultimately, I think they get this, and they see the writing on the wall. But we just like to see a bit more urgency in some of these things. When you look at Wesfarmers, you look at a share price chart of Wesfarmers. Basically, it was flat from 2012 to 2016, 17. It wasn't until Rob Scott came in and did a fantastic job of cleaning up the portfolio, selling things at the right time, demerging Coles, and the result has been fantastic. And now they're sitting absolutely pretty. Wesfarmers, $60 billion company with no debt, effectively. I mean, that's quite extraordinary. And so again,
they'd be sitting pretty if they'd got Linus.
That would have been good, yeah. And we really supported that deal at the time. I said, this looks a very interesting proposition, a very interesting business. They could have maybe been a bit more aggressive and got hold of that, but anyway, things happen.
So we're up to number 2. What are the other couple of points in your investment?
Yeah, so the quality, so that's where all the work gets done. Then thirdly is the management. And so I think I've spoken a lot about founder-led businesses. That's where we really prefer to look, but obviously there's only a certain universe of those.
What are some of the nuances when you do speak to management, where, whether it's how they speak to their CFO in a meeting or small things you pick up? What are some of the red flags when you do meet with management and you go, oh, we need to scratch the surface a bit deeper here to see if they are what they say? Yeah,
look, I think it goes back to that 1,000-piece jigsaw puzzle where how management speaks to the CFO in a meeting, or what they do, what their history is, what their track record is of capital management, all little pieces that go to form the story. But really, we're not trying to tell companies how to run their day-to-day business, we would have no idea. It's really about those bigger picture things, that capital management, capital allocation, demergers, etc. It's those kind of things that we assess. Do they understand it? Do they get that? Will really drive our conviction levels in that sense.
I'm always very suspicious of anyone wearing a pocket square. Is that something that Airlie have noted in their investment framework?
I'm not going to, I won't exclude myself from all the pocket square wearers out there, and suddenly I'll be in a lot of trouble.
All good. And what about point 4 on the investment framework?
And the last one, of course, is valuation. And this is why I said we come to it last, because you've really got to understand all those other factors before you can judge what something's worth. And that's where the trade-offs are made, I guess, because we all know what a quality business is. And you've mentioned REA a couple of times. I'd love to own REA, but is buying it on 55 times earnings going to work for me?
Yeah.
I don't know. Maybe it'll work. I don't know, but it's not within our framework. That's just not part of our makeup. We can't get there. Love to own it, and we had the catcher's mitt out this time last year. We got too greedy. We should have bought it. It got to 70, 65, 70 bucks. That was a gift, obviously, in hindsight. So it's all about trade-offs, I guess, in that sense. What is quality? What will you pay for that quality? We think the market really underpays for balance sheet strength. So I mentioned Wesfarmers, $60 billion, no debt. The market sort of doesn't give any credit, we don't think, to balance sheet strength until it's crystallised, either through a buyback, higher dividends, capital return, or probably our least preferable, but can be valuating in the short run and hopefully the long run, but a good acquisition.
They will smack them if it looks like they're going to have to raise, though. If you've got the inverse of balance sheet strength and they're going to have to raise, the market will mark them down pretty harshly at times. So I guess you do avoid that.
Yeah.
What about just for retail investors? Do you think they should all have some form of checklist? Like you've detailed your very detailed investment framework that you guys work off, but do you think all retail investors should have, even if it's just a basic checklist of things they're looking out for or learnings from past mistakes that they're trying to avoid before they commit to allocating capital into a business?
Yeah, I think if you're going to be a serious investor with a medium term, and you have to be medium term. I mean, it doesn't work otherwise. And you're you're speculating otherwise. So let's call that out. And then speculating, that's great. I mean, that's fun. That's great fun for a portion of your savings, of what you want to invest. I think that's great fun and go hard for it. That's great. But if you're going to be a medium-term, longer-term investor, you've got to work. Yeah, you've got to have some kind of framework about how you think about things, because otherwise you'll get you'll move with the winds. You'll move with the headlines. You'll be in something and then you'll read something bad about it and you're out because you don't have that checklist that gives you that conviction on why you own a company. Personally, I think you should just look up the ticker code AASF, Airlie Australian Share Fund, and you just put it in that and set and forget, and we'll look after it for you.
But, and just lie on the beach and collect the funds.
That's it.
What I'll let you go in a minute, but talk to me about portfolio construction and how you view that. You mentioned that you're quite concentrated, and I'm assuming with the investment framework you guys have, a lot of similar style companies are going to get thrown up. How do you avoid having a really high level of correlation between the different things you're invested in?
Yeah, that's a good question. I think there's enough choice and breadth in the Aussie market that you can get quite a breadth of sort of exposure, industry and sector exposure. And we've got some great companies here in Australia. When you think about some of the quality businesses we've got on a global stage, CSL, James Hardie, Aristocrat, ResMed, and we've got some companies that really punch above their weight. Macquarie Group, that really do punch above their weight on the global stage. So we've got it. We own nearly all those companies that I just mentioned, and so that gives some great diversification. I think when you look domestically, the risk you've just got to be a little bit careful of is that nearly every company sells to the consumer. We're a real B2C kind of market, business to consumer. So we're always sort of on the lookout for those good B2B businesses that provide just a bit more resilience. Because look, I mean, right now, consumer, what a great place to be. They've got money, they've got a job, interest rates low, feeling rich because of their house price appreciation. It's fantastic, but it's not always the case. So you've just got to be cognizant of just having just watching that exposure to the consumer, I guess, because you think you might be in different sectors, but at the end, you're really relying on the strength of that consumer spending. So that's the thing we sort of probably keep our closest eye on in terms of portfolio construction.
Beautiful. Well, that feels like as good a place as anywhere to finish. So it's been great, Matt. Really appreciate your time and look forward to following Airlie Funds Management from afar.
Thanks, Chris. Much appreciated.
This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au. If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.